Hey, welcome. Today, we're going to pull back the curtain on something huge, the hidden financial machinery that actually builds our world. We're talking about those massive, mind-boggling projects, from continent-spanning railways to giant power plants. So let's dive into the fascinating world of project finance. Just try to wrap your head around this for a second. The Gotthard Base Tunnel, it's a 57-kilometer-long tunnel straight through the Swiss Alps. It took 2 decades to build and cost more than $12 billion. No single company can just write a check for that, right? So how in the world does something so massive, so ambitious, actually get the money to happen? That's the exact puzzle we're going to piece together today. All right, so here's our game plan. First, we'll break down what project finance even is. Then we'll look at the two main ways to get the cash, loans and bonds, before checking out some really creative hybrid players. After that, we'll see the global safety nets that make these risky projects possible. And finally, we'll get to the real secret sauce, the art of sharing risk. Okay, first things first, what exactly is project finance, and what makes it so different from, say, just a regular company loan? Here's the absolute key takeaway. When lenders fund one of these projects, they're not really betting on the big companies behind it. Nope, they are betting on the future success of the project itself. To make that bet clean, they create something called a special purpose vehicle, or an SPV. You can think of it as a brand new little company created for just one job, to build and run that tunnel, and that's it. This builds a kind of financial firewall. So if the project, heaven forbid, fails, it doesn't drag its parent companies down with it. The project has to stand on its own 2 feet. So, you've got this special little company, the SPV, all set up. But now, it needs money. And I mean a lot of money. That cash really comes from 2 main places, banks or the bond market. You can think of it like buying a suit. You can get one tailor-made, or you can buy one right off the rack. And each one has its pros and cons. Let's look at the trade-offs here. On one hand, you've got bank loans, usually from a whole group of banks working together. This is your tailor-made option. They're super flexible. If things go sideways, you can renegotiate. The downside? They're usually for a shorter time, and the interest rate floats, which creates a lot of uncertainty. On the flip side, you have project bonds. These are sold on the open market. They give you these amazing long terms. We're talking 20 years, maybe more, with a fixed interest rate, so your costs are predictable. But what's the catch? They are rigid. Once that deal is set, it's pretty much set in stone. So who in the world is buying these super long-term rigid bonds? Well, it's the giants of the investment world. We're talking pension funds, insurance companies, sovereign wealth funds. See, these guys have to think way, way into the future. They have to pay out pensions and insurance claims for decades to come. So a 25-year bond from a toll road or a power plant that just spits out stable, predictable cash flow year after year, it's a perfect match. Absolutely perfect. But hey, it's not always so black and white, just loans or bonds. Beyond those 2 main pillars, there's this whole world of creative, hybrid financing. Let's look at 2 really fascinating examples that step in to fill some crucial funding gaps: mezzanine and Islamic finance. Mezzanine finance is, well, it's a bit of a strange beast. It's not exactly a loan, but it's not exactly ownership either. It sits right there in the middle on the mezzanine level of risk. It's safer than just owning a stock in the project, but it's way riskier than a standard bank loan. Why? Because if the project goes bust, these lenders only get paid back after the main banks get all their money. So to make that extra risk worthwhile, they get a shot at a much, much higher return. This is the kind of money that shows up when a project is just a little too spicy for the regular banks. This whole idea of sharing both the risk and the reward, it's a core principle in Islamic finance. A fantastic historical example is the Las North Sea oil project back in the 70s. The investors didn't just get a fixed interest check in the mail. No way. They got a direct cut of the revenue from the actual oil that was produced. It was a true partnership. They were in it together. And today, that same idea is behind really sophisticated tools like Sukuk, which are kind of like asset-backed bonds and partnership contracts, all designed to fund huge projects by sharing the outcome, not just lending money at a fixed rate. Now, let's be real. Commercial banks and private investors, they can't do it all, especially when you're talking about projects in developing countries or projects that just have some unusual risks attached. And that's where the global safety nets come into play: development finance institutions and export credit agencies. And the scale of what's needed, it's just mind-boggling. The global demand for infrastructure investment is estimated to hit $71 trillion by 2030. That's trillion with a T. A number that big shows you exactly why these public and quasi-public institutions are absolutely critical to get the necessary capital flowing. So how do these groups make a project that seems unbankable suddenly bankable? Well, they de-risk it in three main ways. First, since they're backed by multiple governments, they have these rock-solid AAA credit ratings. And it's not just about cheaper loans. Their very involvement creates this halo effect that signals stability and makes private lenders feel way more comfortable. Second, they act like a super-powered cosigner. They offer guarantees that basically absorb certain risks, which is often what it takes to convince commercial banks to jump in. And third, they provide political risk insurance. And that insurance is often the final missing piece of the puzzle needed to unlock private investment, especially in developing countries. And all of this brings us to what I think is the real genius of project finance. It isn't just about finding the money. It's about deeply understanding, allocating, and managing every conceivable risk. A huge project is like an orchestra of risks. And the whole point is to make sure every instrument is being played by the absolute best musician for the job. This right here, this quote is the golden rule. It is the single most important idea in all of project finance. Seriously, every single complicated contract in a multi-billion-dollar deal is built around this one simple principle. Give the risk to the person or company best equipped to handle it. And here's what that looks like in the real world. So, if you're worried about the project costing too much or being finished late, you transfer that risk to the construction company with a fixed-price contract. It's their problem now. Worried the power plant won't run as efficiently as planned? You sign a long-term deal with a specialist operator. And what if you're worried that no one will buy the electricity you're producing? You get the local utility to sign a 20-year take-or-pay contract, which guarantees they'll pay you whether they use the power or not. See? Every major risk is identified, it's packaged up, and it's handed off contractually to an expert. You see these principles formalized all over the world in what are called public-private partnerships, or PPPs. In Turkey, for instance, you've got frameworks like BOT, that's Build, Operate, Transfer, where a private company builds and runs something for, say, 25 years before handing it back to the government. Or BOO, Build, Operate, Own. These aren't just acronyms. They are detailed legal blueprints that spell out exactly how these crucial risks and responsibilities are shared between the government and private companies for the entire life of the project. When you get right down to it, project finance isn't really a single product. It's an incredibly powerful and flexible toolkit for making the impossible possible. And as we face the enormous challenge of building the green and smart infrastructure of tomorrow, the real question isn't whether we can afford it. It's how we're going to adapt and evolve these sophisticated financial tools to build our shared future.